You were never supposed to understand this system by accident, not from a buried notice, not from a premium deduction that kept growing while your check barely moved, not from a line item on a statement written in the kind of language that makes honest people put the paper down and assume somebody else must understand it better. I do not like systems that rely on confusion. I never have. I made my fortune by looking for places where the crowd accepted a surface story and ignored the real economic engine underneath it. Social Security is full of surface stories. A cost of living increase sounds generous until another hand is already in your check. A benefit formula sounds fixed until you realize an old rule was quietly cutting the money of people who had earned it. A Medicare premium sounds official until you discover it may be based on income from 2 years ago that no longer reflects your life, and a retiree who keeps working thinks the government is stealing from him, when in many cases the real problem is that nobody ever explained the rules before the withholding started. That is why I want to walk through this slowly and clearly, because the people who protect their retirement are usually not the people with the fanciest advisors or the loudest opinions. They are the people who know where the leaks are before the water starts rising. Let us begin with the thing that looks like a raise and feels like a raise for about 5 minutes. For 2025, Social Security benefits received a 2.5% cost of living adjustment on paper that sounded reassuring. The government could point to a number, commentators could call it relief. A retiree could look at the statement and see a slightly larger deposit and tell himself he had at least not fallen behind completely. But most retirees do not live on paper. They live at the grocery store, at the pharmacy counter, at the gas pump, at the doctor's office, in front of the power bill, and in front of the insurance renewal that always seems to arrive with a cheerful smile and a larger number. That is the first trap. Let me make the COLA problem even more concrete. Imagine a married couple living mostly on Social Security, modest savings, and whatever interest or dividends still find their way into the account. They hear that benefits are up, they tell themselves they got a raise, then the pharmacy plan changes. The homeowner's insurance rises, the car policy renews higher, the power bill jumps in the hottest months, Medicare takes a larger slice before the deposit lands. By the end of the year, they are not asking where the raise went. They are asking why the checking account feels tighter, even though the government said their benefits increased. That is what happens when a household confuses nominal improvement with real improvement. I never like nominal thinking. A business can report bigger revenue and still be weaker. A stock can rise and still become more dangerous. A retiree can get a bigger check and still have less room to breathe. If you do not measure what remains after the deductions and after the bills that matter most, you are not measuring the right thing. The official inflation number is not the same thing as your inflation number. If you are retired, your spending pattern is not built like the spending pattern of a 35-year-old household. You are more exposed to the very categories that have been the most stubborn, the most recurring, and the least forgiving: healthcare, housing, utilities, insurance. The categories that do not care what the headline number says. The categories that continue taking bites out of a fixed income month after month. So I want you to think about the COLA the right way. Do not treat it as victory. Treat it as oxygen, useful, necessary, helpful, but not enough by itself to solve the problem of living costs pressing harder than the system admits. And the reason that distinction matters is because plenty of retirees never get to enjoy the full increase anyway. They see the bigger gross number and miss the silent subtraction that comes right behind it. That silent subtraction is Medicare for 2025. The standard Medicare Part B premium rose to $185 per month the year before. It was $174.7. That is an increase of $10.3 a month, or $123.6 over a year, coming out before many people ever see the money. If your Social Security benefit rose by something like $50 a month, Medicare already reached in and carried away more than 10 of those dollars. Your raise was real. But it was smaller than the headline. Your pocket felt the net, not the gross. That is how retirements get squeezed. Not always by one dramatic event, more often by a series of official adjustments that each sound reasonable in isolation and feel very different when combined. Now we reach the point in the story that most people missed entirely while they were staring at the COLA number. For millions of Americans, the truly important change was not the percentage increase. It was the destruction of two old penalties that should have been challenged much sooner. I am talking about the windfall elimination provision and the government pension offset. If you never had to deal with those rules, count yourself fortunate. If you did, you know exactly how corrosive they were. These were the rules that told a teacher, a firefighter, a police officer, a postal worker, or another public employee that even if they had earned Social Security credits in covered work, their benefit could still be reduced because they also had a pension from work, not covered by Social Security taxes. And if a spouse or widow was counting on benefits tied to a husband or wife who had paid into the system, the government pension offset could reduce or even wipe out those benefits entirely. Think about the psychology of that. A family spends decades working, paying, serving, sacrificing, and planning. Then when retirement arrives, the system tells them that the benefits connected to those years will not be honored the way they believed. Not because they cheated, not because they failed to work, because a formula was written in a way that punished the structure of their career. That sort of rule breeds resignation, and there is another layer people overlook with WEP and GPO. The financial damage was obvious, the emotional damage was quieter. When a household expects one number and receives another, it starts rearranging life around the lower number. Trips get postponed, home repairs get deferred, gifts to grandchildren get scaled down, prescription choices get weighed harder. A widow who should have had a larger survivor benefit does not simply lose dollars. She loses options. That is why a correction years later matters so much. It is not merely an accounting fix. It is the restoration of breathing room. That is why I want the right people to pay attention here. Some public employees were never affected because they worked in Social Security, covered employment. But some were affected very directly, and if you were one of them, old resignation is now dangerous. The rule changed. The correct response must change with it. And resignation is expensive. In January 2025, the Social Security Fairness Act was signed into law, and it repealed both WEP and GPO. The repeal applied retroactively to benefits payable from January 2024 forward. Then the Social Security Administration began the hard part, recalculating cases, processing retroactive payments, and raising monthly benefits for people who had been underpaid. The agency said retroactive payments began going out in early 2025, and that most affected beneficiaries started receiving higher monthly payments in April 2025. Through March 2025, the agency had already paid billions of dollars in retroactive benefits, with the average retroactive payment running into the thousands. That is not bookkeeping trivia. That is real money returning to real households. And what matters to me here is not just the law change, it is the lesson. A great many people accepted a reduced check for years because they assumed the system's answer must be final. They saw the amount, felt the disappointment, and stopped there. Never do that with an important number. Never stop at the first number if the number governs your future. If you worked in a public sector role where Social Security taxes were not paid, if your spouse did, or if you ever lost a spousal or survivor benefit because of one of those provisions, you should look at your case with entirely fresh eyes. Old assumptions are dangerous after a legal change. A wrong assumption that lives one extra year can cost more than most people imagine. Now let us move from fairness to another part of the system that punishes stale information. IRMAA, that is the Medicare income, related monthly adjustment amount, which sounds harmless enough until you realize it is one of the cleanest examples of how a past event can raid a present retirement. Here is how the trap works. Medicare does not simply look at what you are earning now. For 2025, it generally looks back to your 2023 tax return. If your modified adjusted gross income in that earlier year was above the threshold, you pay more than the standard premium, much more in some cases. And this is where plenty of people get ambushed. They are not rich in the way the surcharge implies. They just had a year that looked rich on paper. Maybe they sold a property, maybe they realized a large capital gain, maybe they took a sizable IRA distribution, maybe they retired after a final strong income year, maybe a spouse died and the tax picture changed, the event passes, the income falls, life changes completely, and Medicare keeps billing as if the old year still describes the new reality. That is bad enough. What makes it worse is how many people do not know they can challenge it. If your income has gone down because of a qualifying life, changing event such as retirement, work reduction, work stoppage, death of a spouse, divorce, loss of pension income, or certain other events, Social Security allows you to ask for a new IRMAA determination. The tool for doing that is Form SSA 44. That single form can mean the difference between passively overpaying and restoring a meaningful amount of cash flow to your life. I have always preferred decisions that improve your position without requiring heroics. Filing the right form when the facts support it is exactly that kind of decision. No grand prediction, no speculation, no market genius. Just removing friction that should not be there anymore. And this is one of the reasons I tell people that retirement is not just about accumulation, it is about maintenance. It is about protecting every stream of income from needless leakage. A dollar saved by correct administration is worth the same as a dollar earned by investment. Now let us turn to another area where the government can appear to be taking money from you, even when the truth is more complicated. If you claim Social Security before full retirement age and continue working, there is an earnings test. In 2025, if you are under full retirement age for the entire year, the exempt amount is $23,400. If you earn more than that, Social Security withholds $1 in benefits for every $2 you earn above the limit. In the year you reach full retirement age, the exempt amount is much higher, $62,160 for 2025, and the withholding formula is $1 for every $3 above the limit for months before full retirement age. Once you reach full retirement age, the earnings limit disappears. People hate this rule because it feels punitive. It feels like the government is punishing work. What most people never hear clearly enough is that withheld benefits under the earnings test are not necessarily gone forever. When you reach full retirement age, Social Security recalculates your benefit to give credit for months in which benefits were withheld. That does not eliminate the short-term cash flow pain, but it does change the economics of the decision. So the right question is not emotional. The right question is strategic. If you are collecting early and still working, have you run the numbers carefully enough to know whether your current earnings justify claiming now, waiting, or changing the timing? A retirement that is not measured gets pushed around by rules. A retirement that is measured starts using the rules instead. And now we come to one of the oldest, ugliest little traps in the system, the taxation of Social Security benefits. Many retirees think of Social Security as something they already paid for, and emotionally they are right to feel possessive about it. They saw payroll taxes come out for years. They built their habits around the idea that these benefits were earned. Then retirement arrives, and they discover the federal government can tax part of those benefits depending on combined income. For an individual, once combined income rises above $25,000, up to half of benefits can become taxable. Above $34,000, up to 85% can become taxable. For married couples filing jointly, the thresholds are $32,000 and $44,000. What makes these thresholds especially nasty is that they have been stuck in place for decades. Inflation moved, benefit amounts moved, healthcare costs moved, everyday life moved. The thresholds did not. That means the trap quietly widens over time without Congress having to openly announce a fresh squeeze. More retirees get pulled in, more benefits become taxable, more households discover too late that a few extra dollars of other income can have consequences they did not anticipate. The taxation issue deserves one more blunt observation. When people hear that up to 85% of benefits can be taxable, some of them immediately assume that means 85% of the benefit is lost. That is not what it means. It means up to 85% of the benefit is exposed to federal income tax in the calculation. But even after you understand that distinction, the planning problem remains very real. A retiree can take what looks like an innocent extra withdrawal from an IRA, discover that more Social Security became taxable, and end up feeling as if one decision triggered 3 different penalties at once. That is why retirement income is so often mishandled by otherwise intelligent people. The rules do not attack one by one, they stack. This is why retirement income has to be designed, not merely received. A withdrawal from one account can change the taxability of another benefit. A capital gain can change Medicare costs. A pension can interact with Social Security. An old tax year can determine a current premium. A misunderstood record can understate what you are owed. One system talks to another, whether you understand the conversation or not. That is the hidden reality. Retirement is not a pile of separate benefits. It is an ecosystem. And once you see it that way, the next steps become much clearer. If I were sitting at a kitchen table with someone who depended on these checks, I would not start with abstract opinions. I would start with a sequence of simple actions. First, I would log into the My Social Security account and look at the record directly. Not guess, not rely on memory, not assume last year. S-statement still tells the full story. Look at the benefit estimate, the payment amount, and the earnings record. Social Security benefits are built from your highest 35 years of indexed earnings. If a year is missing or wrong, the error can follow you for a very long time. Second, if there was any public sector employment in the picture, mine or a spouse, I would review whether WEP or GPO had affected the case and whether the repeal should have changed the amount. I would not assume the system corrected everything instantly or perfectly. Large agencies process millions of records. A person who checks his own case has an advantage over a person who merely hopes the machine got him right. Third, if Medicare premiums look too high relative to current life, I would ask whether the premium reflected a tax year that no longer describes reality, retirement, divorce, widowhood, work stoppage, a major income drop. If one of those had occurred, I would look hard at Form SSA 44 and the appeal process for a reduced IRMAA determination. Fourth, if work income was still coming in while benefits were being collected early, I would compare that earnings figure against the current year's exempt amount and model the effect before the withholding notice arrived. Surprises are expensive, mostly because they show up after spending decisions were already made. Fifth, I would stop thinking of the COLA as permission to relax. I would treat every increase as an opportunity to redirect attention back to the full net picture. What rose, what was deducted, what became taxable, what changed because of the spouse, what changed because of Medicare, what changed because of an old rule being repealed. The household that keeps asking those questions ends up in a much stronger position than the household that celebrates the headline and ignores the machinery. I also want to say something about the hold times, the paperwork, and the exhaustion that many retirees feel the moment someone tells them they should call the agency, gather records, or file an appeal. I understand the resistance at the point in life when income should become simpler. The administrative burden can feel insulting. You paid in for decades. You should not need a scavenger hunt to defend the benefit. But reality does not reward our irritation. It rewards follow through the retiree who says, "This is too much trouble," often loses to the retiree who says, "I dislike this, but I will still finish it." That difference sounds small over a retirement. It is not. This is the deeper point. Retirement loss rarely announces itself with a trumpet. It arrives in paperwork. It arrives in the difference between gross and net. It arrives in an old tax return that still controls today. S premium. It arrives in a rule you never heard of until it cut your check. It arrives in a spouse, S record. It arrives in a misrecorded earnings year. It arrives in a threshold that never moved, even while everything else did. And because it arrives in administrative language, many honest people assume there is nothing to be done. There is almost always something to be done. Not always something dramatic, but something, a correction, a call, a document, an appeal, a recalculation, a challenge to an old assumption, a better understanding of how the pieces fit together. I built my life on the idea that small edges, repeated intelligently, become very large outcomes. That is true in investing. It is also true in retirement administration. A $200 monthly increase that was wrongly suppressed for years is not small. A Medicare surcharge removed because your facts changed is not small. A corrected earnings year on a record used to calculate a lifetime benefit is not small. An avoided tax surprise is not small. An understanding of the earnings test before you trigger it is not small. None of this is glamorous. All of it is valuable. And that is why I want to close with a very plain message. You spent decades paying into this system. You do not owe the system passivity on top of that. You do not owe it blind trust. You do not owe it silence when a number looks wrong. The system is large. It is rule-bound. It is sometimes slow. It is sometimes opaque. It will not care about your retirement with the same intensity that you do. That is not a moral judgment. It is a fact. So bring your own intensity, bring your own curiosity, bring your own skepticism, bring your own pencil, look at the deposit, look at the premium, look at the earnings record, look at the old offsets, look at the tax thresholds, look at the appeal rights, look at the exact dollars, not the comforting language wrapped around them. Because once you see the real picture, retirement stops feeling like something that is merely happening to you. It becomes something you can defend. And at this stage of life, defense matters. Not fear, not panic. Defense. That is how you keep what you earned. That is how you make the system answer to the facts instead of the other way around. And that is how people who worked all their lives stop slowly leaking money through rules they were never meant to ignore.